Okay. Are you good to take minutes, Amy?
We asked, or we're going to ask Rebecca to take the minutes, even though she's not here. Take them off the video.
Okay, got it. Cool. All right, so we'll call this to order at 5:41. First item on the agenda is approval of minutes. We are still waiting on regular and special meeting minutes from October 20th and October 30th. We do, however, have special meeting minutes from December 1st. They are in the email, so motion will be in order to approve those minutes.
I have read them, so if you want, I will make a motion that we approve the minutes of the special meeting December 21st.
I second.
Any discussion? All members in favor?
Aye.
Aye. Any opposed or abstained? All right, passes unanimously. All right, next is public comment. Any public comment? Seeing none, communication, any communication from anyone on the board? All right, seeing none, next up would be the gentleman from Webster. You guys have the floor.
All right. Well, thank you. Before I start, I just want to make sure everybody has a copy of our performance report. If so, right under, or I would say page 3 of the PDF is recapping Q4. Executive summary, if you will. So pretty good quarter, again, as the market continues to look past the pandemic to better days in 2021. The S&P was up 12.15% for the quarter, which got us to 18.4% year to date. Miraculous comeback. As you know, back in March, we were talking about a 34% downdraft in the S&P. It's been a nice V-shaped recovery. And what started a year of a lot of optimism back when we were talking about the trade war, where COVID just ravaged the economy and the market had dropped, and now we're talking about 18% returns and all-time highs. So quite a roller coaster year. On the international market side, quite well in the fourth quarter, up 16.05%. They ended the year at 7.8, and the Barclays Intermediate Gov, that's our fixed income benchmark, that was slightly up 0.48%. For the year, it was up 6. Most of that came when investors were fleeing to safety. But the last couple of quarters in the fixed income space has been pretty flat. So, just minimize my platform. On the economic side, the pace of the unemployment recovery has slowed significantly. Last look, new unemployment claims last week rose 180,000 to 965. So it's bucking the nice trend we had over the summer into early fall. Kind of leveled out, and now, unfortunately, with the second wave of COVID, we're seeing a lot more layoffs. Continuing claims also increased 200,000, with about 5.2 million unemployed continuing claims at this point. Job growth is certainly slowing. We expected to see a very meager 50,000 or so at the last reading, and we actually were down 140. So the unemployment picture has changed, I would say, dramatically. It's nothing like it was back in March, April, and May, but certainly the trend is slightly reversing. So hopefully the vaccine administration can be rolled out quicker and kind of change that trajectory. Same story on the Fed side. They have promised, if you will, or I don't say promise, but the word is that they will keep interest rates low. Inflation remains relatively low. In 2020, it came in at 1.6, though I will mention that the last couple of quarters, actually going back to the end of May, inflation on an annualized basis for that smaller time period has been around 4.1%. So the expectation is that inflation may start to come up a little bit, certainly because of the monetary and fiscal policy that's in place and the stimulus. Additional stimulus, so we'll see. We got the 900 billion, and now they're talking about another 1.9 trillion package. So, we'll see when that rolls out and how that's going to be put into the economy. The direct payments, a combination, I believe it will. They talked about a combination of direct payments and of additional employment benefits. So we'll probably get more details on that very shortly. So I'll leave the long-term outlook for the end. Why don't I turn it over to Bob? We can go through the asset allocation, share the performance, and then we'll wrap it up with what we're seeing, at least near term, in 2021.
Thanks, Bob. If everybody could just turn, if you look at the bottom of the page 5 of 59. And this is the portfolio summary for the pension account. And the top left-hand side, you can see the overall asset allocation. We're at 66% in equities versus the target of 60. And mainly the overweight is due just to the run-up in the market. Like Bob said, the market was up 18.4% year to date. And during the first quarter, when we had the huge sell-off, it was just so fast that we didn't even have time to rebalance the portfolio. So we just stayed fully invested, and we benefited from that. And you'll see that on the performance page. We continue to underweight fixed income compared to the benchmark. You'll see the fixed income at 29.5 versus the benchmark of 40. But we look at cash and alternative, which is just a preferred fund, as fixed income as well. So if you add those together, we're basically at 34% versus 40. So it's not as drastic as it appears. On the bottom right-hand side, you can see where we started and where we ended year to date. So as of 1/1, we had 29,110,000. And then after all the contributions, withdrawals, income fees, and appreciation, we ended with 33,186,000 for a total return of 14.09%. Any questions on any of the breakdown numbers on the right-hand side or the asset allocation? Okay.
I have a question before we move on. How does that 14.09 compare against the overall?
The overall, I'm sorry, Jay, there's a noise in the background.
How does the 14.09% on the pension plan's earnings compare to the market performance?
I can show you that on page 10.
Okay.
Is that all right? You want to jump there? Or?
No, you go ahead.
Okay. It's very good though, just so you know. But we'll get to that. But on page 6, this is the new page that we introduced last quarter. And you can just see the different asset allocation as the quarters have gone on. One thing to point out, you can see at the end of Q1, our total equities at that point were around 59.7%. And like I said, we just stayed with our overall guidance to stay with our beliefs, and now we're at 66%. But one thing that has increased mostly is the large cap space. When the pandemic started, I thought mid and small cap were going to suffer more than large cap. I thought large cap had more of a global presence, and not only that, but the stay-at-home stocks as well. So I had reduced small and mid and added to large cap. Any questions at all on that page? Okay. And Jay, to your question, if we go to page 10, and if I'm going too fast, please let me know. So on page 10,
Ed,
like,
could you mute yourself?
I'm
We're
sorry.
picking up a lot of background from you, I think.
Yeah. On page 10, if you look at the second column, well, we can look at the first one, this last 3 months. So like Bob said, the market was up 12.15% in the fourth quarter. It was a really great quarter. So we picked up 7.7% as a total portfolio versus the benchmark of 7.68. But on the 1 year number, we did 14.09 versus the 13.76. And if you drill down a little bit lower on that page and look at our domestic equities, which includes mid and small, we did 20.89 versus the S&P of 18.4. But on our international exposure, we actually doubled the MSCI EFA. We were at 15.59 versus 7.82. Now we continue to stay short duration on the fixed income portfolio, which hurt us a little bit as rates did drop from 0.9 to 0.5, historic lows during the year. But by the end of the year, it had come back up. If you look at interest rates right now, they're at about, the 10-year treasury is at about 1.10, which is significantly higher than 0.9. It's only 20 basis points, but at those levels, it's really significant. And we continue to believe with the rollout of the vaccine and fiscal stimulus that economic growth is going to be prevalent, and it's going to continue to make rates increase over time. So we're going to continue to stay short duration. But then you can see the 3 and 5 year number, pretty close in line on the 3, slightly under, and then basically in line on the 5 year number. And then you can see since inception, we're up 9.5%.
Hey, Bob, what do you think, where did the overperformance on the international come from?
This MFS intrinsic value fund, it did 20% last year versus the benchmark of 7. And then if you look, and then on the international emerging markets, we use the Matthews Asian Pacific Fund, which is about 96% in Asia, and it did about 28%. So by adding the emerging markets as well as the MFS intrinsic value, it really helped.
Would you consider dumping the international ETF?
No, because I don't want to put all my bets in one manager, and I like having a stake in the ETF. It's a low cost, fund, and then I can just try to add some alpha with the manager, because as you know, David, I'm sure, a manager could have a great year and then just sink the next year.
Yeah.
So I like having a stake in the index.
Right.
Any other questions on that page? Okay. If you all would go to page 11, I'm sure you remember all seeing this page. There's a lot of information on here. But the third column in shows you net flows. So this will show you activity throughout the account for the whole year. And then the fourth to the last column on the right will show you the total return for each asset and asset class. So just for an example, like I said, we liked large cap this year, and we liked technology specifically. Growth continued to outperform value this year. Growth was up about 38%. Value was up about 2%. Having said that, growth is a lot of technology, and our Fidelity Contra Fund, which is the top line, has a very high concentration in technology. So I had added more money to that, and you'll see that in that net flows column. I had added $865,000 during the calendar year. But if you look at the return column, the fourth from the right, you can see it did 32.53% versus the S&P doing 18.4 for the year. So in my response to David's question, what I like to do is buy the index. So we took advantage of the S&P being up 18%, but we also found some really good manager that outperformed the market overall. And then you can see all the names down below, but you can see I did sell the iShares Russell mid cap throughout the year. There it's a 1% position, so I'm comfortable holding just a manager there. And then in the small cap space, it looks like I sold the JP Morgan small cap equity and repurchased it. But with the size of our relationship with JP Morgan, the larger it gets, the lower share class we get. So all we did is just basically a share class exchange. And then if you go to page 12, you'll see a large number in the net flows column next to the iShares Intermediate of Credit. I just wanted to get closer to the overall benchmark as far as duration and credit quality. So I put a large chunk into that. And then it looks like I sold a lot of individual bonds down below, but those are actually just maturities that are rolling off. And I'm just using some active managers as well, being the JP Morgan and MetWest. And you're going to be seeing that over the next couple months as well, because we have, through April, we're going to have about $825,000 of the fixed income portfolio maturing. So with rates being so low, I just figured we could use some active managers and some ETFs instead of just buying individual bonds at this time.
Awesome.
Any questions?
Any questions from the board? All right. I think we're pretty good. I mean, I know it's been quite a year, so happy to see we didn't do anything crazy and we wrote it back up.
Yep.
If you want to quickly touch on the OPEB, I mean, I see it here. Just briefly, would be good because, kind of like I mentioned, I have to run at 6:15, so I want to make sure.
I'll try not to ramble on. So if we go to page 15, pretty much close to the same. It's about 65% in equities. We have a little bit more cash, and I'm just looking at that as an opportunistic time if we get some sort of a pullback, just to add to equities. And then we can just go to page 19, and you can see the overall performance since we started managing this as well. And the numbers are relatively close to each account. The 1 year, again, was 13.99, 3 years at 9.58. And then since inception, it's over 9%. So I think the numbers look good overall. I like the way we are positioned. I don't think there's any changes that need to be made right now. Small cap has had a huge run. It was up 33% in the fourth quarter, excuse me. And it's up 8% this year. I would just look for a big drawdown on that at any time to add to that position. I know in the IPS, we state that we can get up to 5%, and we're at 1 right now, but I just think it's overpriced.
Awesome.
And that's basically all I have, unless anybody has any questions.
Any questions, folks?
Yeah,
I think we're good.
Looks good.
Yeah.
All right, well, thanks.
I hope everybody stays safe.
All right, guys, thanks.
Take care, guys.
All right, thank you. Have a good night.
Night.
Happy.
All right, moving right along to some old business. We have the pension plan mobility policy. If I recall, Jay, that was something that you guys were going to address at the Board of Selectmen, right?
No, that's something that's supposed to be done here, I believe.
Okay.
My last notes from October say that you were going to take it to your Board of Selectmen. So the deal was, our problem is, do we let people change each time they go from union to union, or do we set something that says you go to whatever your union is? So even if you're a DB participant in one union, if you change positions and take a job in a union that no longer has DB, you don't get to keep it anymore.
So it's probably going to cross into labor stuff. I would
Yeah,
imagine.
for sure.
Yeah.
Amy, can you and I chat tomorrow about that? I can talk to the selectmen in executive session Thursday. But
Okay.
I think that's going to be impacting every bargaining unit.
Yeah, that was why we wanted to get you guys in. It sounded like the preference here on the pension board was to have it so that the plans are tied to the unions. Essentially, like if you were in a pension and you go to something that's a DC, you will now only participate in a DC and you'll lose that participation in the DB.
We can't be the only community that has that as an issue.
I mean, I would say the only good thing is that the reason this is coming up is because we do now have these hybrid plans. We have the DC plan for clerical. Like we've got now multiple. The cat does the same thing. I have to close the doors to keep them out. So it is new to us, I guess, right?
Yes, because basically we now have, so we've had a couple instances. One was quite a long time ago. Somebody went from clerical, went to dispatch. They got to keep their plan. Then a couple of years ago, we had a couple more. One went from unaffiliated, had a DB plan, went to clerical, who had a DC plan. She stayed DB. But in the other case, we had a clerical person who was DC who switched to supervisor union, and they got to switch to DB.
Yep.
So in each case, it's been to the favor of the employee. So in each case, they went to the DB plan, which is obviously a better plan. Or stayed with the DB plan if that's what they had. But that was counter to what the union contracts are. Because the union contract says if you come in as a clerical employee, you are now a DC. So that is something we need to consider as people move around and we have more and more divergence between what people have. And we have another thought that's coming. Somebody asked me about a full-time firefighter. So we don't have a pension appendix for them.
Well, we don't have a bargaining unit for them either.
So that's one more thing that needs to get on our radar if that's coming.
Do we have a full-time firefighter yet?
I think they're asking for it in this budget cycle.
Okay.
The issue though is, and I don't think it's going to become an issue in the near term, because we're trying to make it clear in the, you know what, I'm going to stop right now because we're in open session. But I am trying to address Amy's point a different way.
Okay. All right, so I would get let's just get the Board of Selectmen involved and see what their thoughts are on setting a policy there. And, kind of tying that to the fact that we now have all these new plans, right? Or subsections of the plans. So we need to have a official policy one way or another.
My recollection on that whole plan movement thing was that, and I don't think we voted on it, but my thought was, I didn't think we did. My thought was, whatever job you're moving into, that is the plan you will get going forward, but you will freeze the plan that you are leaving from.
That's
My
correct.
recollection too.
Yeah, that was the mood of this board. It's just that we also want to have, I think, the Board of Selectmen sign off on that as well.
And likely impact bargain it.
Yeah, I mean, you'll have to talk to them. It's all those plans have already been bargained with the unions. I mean, it's because they are switching technically unions.
They're switching bargaining units, but in most cases, not unions. There's only one different union. There are 2 unions and a whole bunch of bargaining units.
I know.
Think of it from the perspective of the union for a minute, and I've never been in one, so I maybe shouldn't even be talking, but if we allow them to pick the better of the 2, wherever they end up going to, that's discrimination in favor of that person that's on the move and against all the other people who are stuck. You know, if I'm a DC employee and my partner in crime comes in and she tells me, well, I'm a DB and I'm staying a DB because I can, that seems as though the union would have an issue with that because now we're not treating them fairly. By making it whatever you migrate into is what you get going forward, that seems to be fair for the members of that union.
I'm sure it'll be a conversation. So. All right, thank you, Jay. Approval of defined, any other comments on that? I think, you know, let's get, again, the BOS to weigh in and we can reconvene on that, I think, next meeting. All right. Approval of defined benefit investment policy statement. Were we waiting? Yep.
So I'm not sure if we approved it in October or not, but my note said that we wanted them to include OPEB. And the answer back from George is you really need a separate plan for OPEB. You can't use the IPS for both. So I can't remember if we approved it, amending George's comments on whether we could do OPEB at the same time, or if we didn't approve it, we waited because we wanted to know whether we could include OPEB or not. And I can't find the minutes because they're not out there yet.
That is really unfortunate. I think we'll have to table that and keep that for the next meeting then.
Sorry.
No, that's okay. I sent, by the way, Amy, I sent an email to Rebecca as well. I CC'd you and Jason.
Okay.
All right. Executive session. Do you guys?
I don't think we need it.
I agree. I think we're pretty much all caught up on negotiations. So unless there's anything else, guys, that is all I've got. We will try to get, we're still missing those minutes from the October meetings, and we'll get those hopefully for next meeting.
As well as these.
As well as these, yes.
Well, if that's the case and anyone else is interested, I will put forth a motion to adjourn.
I'll second.
All members in favor?
Aye.
Aye.
All right, so we're adjourned at 6:09. Thank you guys for pulling up. Appreciate getting me out of here on time. So we'll see you guys soon.
Yep, bye-bye.
Thanks.
Bye.